Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday. On this podcast, we spend a lot of time talking about building wealth through property, making good investment decisions and creating financial freedom. But one thing that often gets overlooked is what happens if life doesn't go according to plan. What happens if you're unable to work, if you become seriously ill, or if your family suddenly loses your income. So today we're changing gears slightly and we're talking about something that underpins every good financial plan, and that's protection. I'm joined by Sam Green, one of our protection advisors here at Prime Property Finance. I'm going to have an honest conversation about why protection matters, some of the biggest misconceptions, and what people should be really thinking about. So let's jump right in. Sam, welcome. It's finally a great time to have you on the show. Very excited to talk about today's topic, which I know it means a lot to you, but it historically it also means a lot to me, having been in this space for a long, long time. So yeah, welcome. How are things?
I'm good, thank you, mate. I'm excited to be on and grateful for the ask. I sat and watched the last year and a bit and wondered when I was going to have my opportunity to speak, or if I was even going to be asked. So.
Yeah, no, it's a pleasure having you on. And can I see some balloons there in the background? What's been going on?
Oh, yeah, it's my 23rd birthday.
23rd, yeah, keep dreaming.
Swap the digits. Only works for another year. And then, so yeah, no, I had a lovely birthday last week. So spoiled rotten. Nice.
So happy birthday for last week. And yeah, look, let's jump into it. So thanks for coming on. Really appreciate it. Obviously, I know a lot about your background, but for the purpose of the listeners, would you mind just kind of telling us, giving us a whistle-stop tour as to sort of who you are, a little bit about your journey and how you've ended up being a protection advisor effectively?
Yeah, absolutely. I mean, it was almost my dream from about 6 years old. I said I wanted to grow up and sell life insurance for a living. But no, in all seriousness, I was born in Norfolk, raised in Norwich. I moved to South Wales to study a degree in performance coaching for sports, particularly with a football pathway and background. So I did my UEFA licenses. I spent a year working with Cardiff City, went out to Gibraltar for a year and worked in the Premier League out there, which was all really great experience. Unfortunately, while I was out there, my mum passed away very suddenly and sort of led to being woken up to the world of really protection. So she didn't have a will in place. There was no life insurance in place. My dad was a bit of an emotional mess, as you'd expect it to be, and being the oldest son, I was involved in conversations that 21-year-olds probably shouldn't have been involved in, but it was a harsh reality to me and an awakening to what can happen. From there, I potted around in self-employed jobs for my first ever, it was my first ever job really outside of football, as a door-to-door salesman. So we do like charity or energy grants. And that's what I really enjoyed, learning about myself, learning about human psychology, and especially when it comes to buying and selling. That then led to me taking up sort of like a PT role. One of my clients that we coached was an IFA. And from the moment he met me, basically pestered me into saying, you're in the wrong industry. Somebody with your skill set, mindset would absolutely thrive. Anyway, when COVID hit, he just purchased a solicitor's firm, which only dealt with wills and estate planning. So he said, come and join us. And I became a will advisor. So did that for just under 9 months. Part of that process was, there's flies, we live in the countryside, and they're everywhere. So part of that process, we were looking at life insurance. We were advising on a full estate rather than just writing somebody's will. It was more like a full overview and review. And I saw the amount of money that the IFA firm were making from that and thought, being employed on very low wage and working 70 hours a week with a lot of stress wasn't worth it. So I sourced a way to get into the world of protection and continue the knowledge and skills that I got from the wills to go and do it by myself. And one thing led to another. And through the networking group, I met Gareth. And when Gareth launched Prime, we had a conversation. So I took what I was currently doing and came straight across to Prime because I believe in the way that the firm operates. And obviously, I like to invest in property myself. So it just made a perfect fit.
Yeah, look, Sam, I'd known you for a little while before obviously you came across, and we hadn't known each other for a little while, and it was a bit of a weird way that we met it through the networking meeting. But obviously there was a bit of a clash in what we did, and it was a bit of an opportunity. It was one of those decisions that can send you different ways in life. And I remember just mulling, the opportunity of you joining the group, and there was a clash with what I was doing. But then I kind of just sat back and said, well, I think you would bring value to the group based on what you were doing, and I saw a potential opportunity that we could maybe do something in the future. And yeah, lo and behold, look, you've got a good attitude, and having taken the adversity of the situation with your mum dying at still a relatively young age, although obviously there are people, which we'll probably talk about in a bit, who are not as fortunate to be at 21 years old when one of their parents passes away. That's the reality of life. So, you've had to take that adversity and now you've turned that into a career. So, it's a testament to you that you kind of turned that around and learned from that experience. And part of that is going, well, I don't want other people to go through this experience and go through the pains that you had to deal with, right? So, you've come a long way, and I know you're very motivated to leave a legacy on that front. And also you've got a big... what's the word I'm looking for? You've got a big desire to keep improving from a personal development perspective, and something that I'm also a big fan of in personal development. So we definitely hit it off on that side of things, and long way may continue. It's great to have you on board. So I guess to talk about more around the protection side of things, that's how you ended up. What was obviously you've kind of touched on the points that have attracted you to the area. Why is it kind of more than just selling insurance? What obviously probably means a little bit more to you, I guess.
You just hit the nail on the head there. It's like every time I sit with a client and that client confirms an instruction, it's not just, oh, yes, I've made a commission, or yes, I've been successful. It's actually far deeper than that. I leave that client knowing that if their life was to go seriously wrong, then the one thing that they're not going to have to worry about is money. And I always use the term, if you lose a parent or lose your partner, rather than worrying about money, you actually have the time to sit and grieve and deal with that and the whole process that goes alongside that. And there's being able to not have to worry about the financial side of that allows that process to happen. And it doesn't make it it probably does make it easier, but it doesn't make it any easier, if it makes sense. But it allows for the focus to purely be on that, not as men typically do. If it's the wife that passes away, oh my God, there's a financial problem. I'm going to fix that first because I need to put food on the table. I need to carry on paying the mortgage. I won't actually sit and reflect and deal with my emotions. And then you end up in a whole world of problems, far more serious problems.
Yeah, so I think it's the grieving aspect versus the financial aspect. And if you don't have anything in place, then you've got to deal with both. And usually the financial aspect, and taking care of the family comes first. And then grieving kind of never happens. And that's something that kind of lasts with people for a long time. And if they never deal with it, that can lead to other issues further down the line, can't it?
Yeah, it's absolutely huge. And I think another thing that gets missed in our industry as well is if it's on the reverse and say it's the breadwinner that passes away. It's not the breadwinner, so the one with the lesser income that passes away first and the breadwinner carries on going. There's a lack of realization that the work of the partner, especially if there's young kids involved running a family, the work that person does, which is unpaid in terms of finances, actually often allow the breadwinner to be as successful or be the breadwinner. So I think sometimes I hear these conversations, so it's only important that the breadwinner is insured, but there's no actual realization on, well, the reason why the breadwinner can be the breadwinner is because the partner or spouse is doing such a great job alongside them.
And also, I think another important piece here is around the children themselves. Whereas if it's not the breadwinner goes to work, and then there's a piece that needs to, for them, the important piece is around time then. So it'll give them time to spend with the children to help them on that emotional journey and get them back to where they need to be and the realization of the situation. So yeah, there's so many pieces to it, more than just, this is life insurance. And unfortunately, as Brits, we don't tend to talk about death that much or like talking about it or planning that well about it. I don't know whether it's just the role that we're in, but I feel like there's a bit of a shift. I don't know whether that's because of the changes to inheritance tax planning, with pensions coming into that probably next year, coming within your threshold. I think that's triggered, it seems to have a bit of a trigger in more and more people now seeking that advice, whereas they probably would before. So I think it's a good shift. Not the IHT changes, the fact that people are actually making that active decision rather than needing people like us to actively start up the conversation to make it happen rather than the other way around.
Yeah, and I read a really interesting book around this concept called Willing Wisdom. It was written by a Canadian estate planner, and essentially what he'd done with his family, every year they sit down and review their wills. You think in our country, typically, if somebody passed away, often people don't even know if there's a will, what's in the will, the contents of it. So we used to have this tradition where all the family would go and sit in the solicitor's office and find out what they were due to inherit. You've seen that on like films, and whereas I think if you reverse that and actually make it crystal clear, again, it goes back to giving the family time to grieve and come together, the family that remain, rather than, oh, that's not fair, he's getting this, he's getting that. All those conversations can be had prior to it. And I think maybe with that and the reach of social media and having experts talking about it is hopefully shifting people's mindsets.
Yeah, definitely. So let's move on then a little bit. Let's understand, why is it that people actually often ignore protection? What is it that you see? What are the main reasons why people kind of ignore it?
I think primarily it's that it's never going to be me mentality. It's, I don't need to worry about that, I'm young, fit and healthy, or I'll deal with that later. And obviously we all know that tomorrow never arrives. Secondly, I think people have a cost objection with it. I had a conversation the other day where somebody was like, I don't understand. I'm paying into this policy every month while I'm alive, and I never see any benefit of it unless I pass away. But obviously it's not to benefit from. The benefit is there in case that worst case scenario happens. And that sort of logical thinking can actually totally destroy a family's financial future.
Yeah, and there will be some examples, just using that person you mentioned there will be some people that they have a certain set of circumstances that there is no point in them having life insurance whatsoever. They have no need for it. And that's often true. There will be people that fall into that category, but that would mean that they're probably a single person with no immediate family. But that doesn't mean there's no need for protection. That means there'll be more need on other types of protection. And it's just getting people to understand those different products that are available within this sphere of protection insurance.
Absolutely. I think it's a very typical thing that's done, and maybe because it's more certain. Like I've never met anyone that's not going to die. It's 100% success rate. That is fact. So we all tend to talk about life insurance as the primary protection product, but actually the one that's claimed on the most and the one that is going to see people benefit and probably everybody needs, I don't think I met anyone that doesn't need, is income protection. And, if something happens that stops people from working and earning and living, it's £125 a week statutory sick pay. Now I couldn't feed myself for that. I'm a big lad, but I don't think I'm alone in that concept. It tends to be that, especially from being around other people in the industry, the recommendations tend to be life insurance first, critical illness second, and income protection last. I think there's place to argue that income protection should be first in that conversation.
And this is part of that conversation around, when you look and sit with people and look at their demands and needs and their current circumstances and their future circumstances, and working out the plan. And I guess the bugbear for me on this is where people kind of often will just go and you say, oh, I've sorted it myself, and they'll just go onto an online aggregator, they'll just pump in some information, they'll get the cheapest quote they can possibly get, and then kind of have a whinge and they're not getting any advice. And I think advice in this space is so important, because even as professional advisors, there are still things that we probably don't know, and that the market's changing, products are changing, insurers are coming and going, people are developing and innovating their policies all of the time, some making them better, some making them worse. And if you don't stay on top of that, then you won't necessarily, you won't get that from an online aggregator. So, and if you're just buying on price alone, you're going to end up in a sticky situation, and it's going to backfire. So, ultimately the point about speaking with a professional is understanding all of those options. And like you said, income protection is there to serve a timeline between today and the point at which you kind of retire. The theory being then that your pension income will kick in at the point of retirement and then see you through to, your mortgage debt should be paid off, your pension kicks in, and you're then set up for retirement. So on that basis, the likelihood of you getting being off work for some reason is far more likely than it is for you to die between now and the age of 68 or whatever it is that your retirement age is. So life insurance is cheaper for that reason, because you're less likely to claim on it than you are to claim on an income protection policy, as you mentioned. So absolutely big advocate of income protection.
It doesn't have to be expensive either. There are and one point that we should mention is that to get income protection, you have to speak to an advisor. There's no way you can take it out yourself. You can't go to a money supermarket or compare the market to get income protection. It has to be done through an advisor. But, you can have a policy that will pay out for a 2-year period. Because again, the risk of you needing a payout every month through to the age of retirement for an illness is far lower than if you've got something like a cancer that take you off work, but it'll pay out for 2 or 5 years so that it gives you the income while you recover. So you look at the risk aspect and go, actually, well, if I can't afford the one that will pay every month, having something that will pay me for 2 or 5 years for a smaller budget makes even more sense.
Yeah. So I think some of the things that we've covered then, so the classic one is it won't happen to me. And, there's a bit of human nature in there because we think we're invincible. But the facts are that 1 in 2 people in their lifetime get cancer. So one of us is going to get cancer, so that's the reality of it. I think anyone listening to this will know someone that's had cancer, that's had a heart attack. They know somebody who's passed away with a child under the age of 18. There's so many things. We can just keep going around all of these different scenarios. One of the other ones then that we've mentioned, which is cost misconceptions. I think the cost misconception is related to understanding priorities, because ultimately, we're talking about anyone here with a job who has income to protect, obviously. So they can afford it, even if it's something. When they say they can't afford it, it means that it means that they don't prioritize it. What's your kind of stance on cost versus priority?
I think for anyone that says they can't afford it, the first exercise they should do, if they're really serious about it, is look at the bank statements. I walked into Cost the other day and it was a £5 for a cup of coffee. If you have one of those a week, there's 20 quid that you can give up, and you can make a nice coffee at home for a fraction of that price.
20p.
For 20p, and then financially protect yourself instead of having a Costa, So I think it's not a case of can't afford it. And it probably falls on us as an advisor to educate on the value of it. I think that's more of if you've sat in front of somebody who's good at what they do, they can identify the problem. The client knows that there's a problem if they can't work. It's then painting the value of that.
A lot of the time, my argument is, when people say I can't afford it, it's almost like you can't afford not to have it. Because if you're at the point right now, whilst you're working and money's a little bit tight because you're not managing your budget that well, then if money's a struggle now whilst you're working, what do you think money would be like if you were unable to work and you've got no income? It's a no-brainer.
Oh, and the other way you can look at it is if the government upped the tax tomorrow, you'd all pay it because there's no way around that scenario. So you could almost look at it as if the government increased your tax, but in exchange you'd get your income paid up to 70% if you were signed off work long term. Nobody would have any way around it. So you've almost got to look at it as a tax that you put on yourself, but that tax is to actually benefit you, where some taxes you could probably argue don't go to benefit you.
Yeah, absolutely. And what about, from an education perspective? Do you think there's a lack of education or a lack of understanding around the various products that are out there?
In terms of the client, yes, I wouldn't say it's their place to necessarily know the nuances. So I had a client this week who came to me for life insurance. So this is not off topic of income protection, but having had a TIA and AF, had been told by another advisor that he couldn't get cover. But I've placed him with a provider who is covered and only loaded at 25%, and he is absolutely ecstatic at that. So I think it's if you've been told by one person that you can't get cover, go and seek somebody who maybe has a little bit more experience. And I don't want to bash any particular advisors, but if you're a mortgage advisor who's very busy, your priority is life and kick for the mortgage. I've done my bit of protection, especially if you're employed. Case closed, I can move on to the next one because the pressure's on that advisor. But speak to somebody who deals with protection all day, every day. Any client that comes in, I want to get them the result they're looking for. So we'll go above and beyond. And part of the process to get him covered, we applied to 9 different providers for him to find one that will say, yes, we'll do it.
And sometimes as well is the people who, I've had one in the past where people say, oh no, we're not interested. And then after a while, they'll come back to you out of the blue and say, oh, can we take that cover now? I want to get it sorted. And you're like, oh, great. Glad you changed your mind. I'm like, yeah, this has happened. And you're like, it's too late now because it's happened. You've missed the boat now. Either you're not going to get covered based on the medical item that's happened, or if they're not going to cover you for a while, if they do, there's going to be exclusions on there, or it's going to be very expensive. So whilst you're fit and healthy is the time to take action. And I think it's a little bit like, we often talk about the demand of, obviously we do mortgages for people, and people come to you because they want the outcome of wanting a house. All they're interested in is getting the keys to that house. So getting the mortgage set up for them is like serving the purpose to get them to the end goal of getting the keys in their hand to open the doors. Whereas when it comes to protecting that, then it's people can't see the outcome. They can't feel the keys in their hand, for want of a better word. They can't feel like, all right, if I take this insurance now, if I die, or if I have a critical illness, or if I'm off work long term, they can't see the money coming into the bank, or they can't feel it in the same way that they feel the keys in their hand.
One of the best analogies I've heard for this is if somebody books to go on a cruise, you can almost guarantee that when they're booking that cruise, they never ask the question, are there lifeboats on board? Because you rarely hear of cruises going down. But if there was a difference of £50 on a holiday where you go, you can have this cruise, but there's no lifeboats on board, but this one's £50 more, but there's lifeboats on board, most people are going to spend the 50 quid to go on the cruise with lifeboats, even though the chances of it happening are so slim. So essentially your insurance package is just you building a lifeboat for your family, because you hope that the boat never goes down, but you're going to want to be on one with a lifeboat on board if it does go down.
Yeah, absolutely. Knocked the nail on the head mid there. So let's clear up a few sort of myths then in regards to insurance. Obviously there's a fair difference between life insurance, critical illness, and income protection. If people would only kind of understand the difference, what would it be on those?
So the difference between the 3 products? So yeah. Life insurance is like Ron said, it insures your life. So it does what it says on the tin. If you pass away before a set age, then you receive a payment for that. Critical illness is if you develop a defined, so depending on the provider and the policy, but there'll be one of a defined list of critical illnesses that they put in the terms of the policy. So if you develop one of those, it doesn't have to be terminal, but if you develop one of those illnesses, again, a lump sum is paid out. And income protection is anything that a doctor or GP will that will sign you off for work or give you an off work certificate after a set period of time, which we decide together based on your circumstances, your savings, your level of income required. Then you'll start after that set period of time, receive a monthly payment into your account, and that payment can continue for a set period of time. So it can be limited up to 1 year, 2 year, 5 years. It can be until you return to work. It can be until you hit retirement age, or it can be until you pass away if it's before retirement age.
One of the biggest myths or probably objections that I see and a misunderstanding in the space is around terminal illness. People think they've got terminal illness, so life and terminal illness cover, and they mistake terminal illness for critical illness. Do you want to just explain that a little bit?
Yeah, so a lot of life insurance policies will have the terminal illness clause in it, which basically says if you're diagnosed with a terminal illness that's often means that you're going to pass away within 6 months, they'll pay out the life insurance policy. Critical illness is a predefined list that doesn't have to be terminal. So you can develop a cancer, a low-grade breast cancer, for example, that isn't going to kill you because the treatment's there to prevent it from doing so. If you only had your terminal illness through life insurance, you're not getting a payout for that because the breast cancer isn't going to kill you. Whereas if you have a critical illness policy and you get the breast cancer, then you would receive the lump sum payout.
Yeah, awesome. Thank you. Okay, so obviously, the main purpose of this show is to talk around property investors. And so why do you think, the protection is important from a property investing perspective, and why should investors think differently about this if they haven't really given it much thought?
Yeah. So I hear property investors go, I don't need life cover because I've got equity in the property, or I don't need income protection because I've got the monthly income coming in. I don't need critical illness for those same reasons. But most people, I guess, are still in the process of building their property portfolio, and they're reliant on income outside of the portfolio to do that. So if you're relying on an income that's not from your property, why would you not want that income protected? Because obviously if something happens to stop you working, yes, you may still receive some income from property, but you're not going to have the extra income that you were working to have. So you want to protect that so you can carry on building your property portfolio at the same rate that you are currently without the hardships associated with it. Life insurance for property investors, I've done a couple recently where they've both been divorced, got together, they've set up a company together, they've both put directors' loans into the company. Obviously, if something was to happen to them in the interim, that loan is swallowed by the company. There needs to be an agreement in place that it comes back out and paid to the chosen beneficiaries, because neither wants to go into partnership with the spouse's children or beneficiaries. So there's that consideration to think about. Obviously, with the inheritance tax rules coming into play as well, if your portfolio is taking you over the inheritance tax allowance, a lot of people don't realise that when somebody passes and goes through probate, the inheritance tax has to be paid before anything else. So if you've got a portfolio that takes you over the inheritance tax threshold, and you'll go, oh, it's all right, they'll just sell a couple of properties to pay that bill. But if a property takes 6 months to complete, where are your beneficiaries or executors finding your bill to pay in that 6 month period? So it's all of these caveats that you need to consider and think about, rather than I've got property, I've got money, equity in that, so everything's going to be okay. There's problems that you haven't necessarily thought about prior to that.
One of the biggest challenges I see really, especially for like the people that you mentioned in terms of the ones growing their portfolios, pretty much all of them are maxing out the loan to values on the portfolio, because generally what people go through an aggressive growth phase. So they're trying to use momentum and recycle as much of the cash and equity as they can in their portfolio to buy more property. And then they'll get to a level which they're kind of happy with. And then after that, you have a bit of compound, sort of a bit of appreciation in value, which reduces your loan to value a little bit. You might be paying some of the loans down. And so the more mature landlord then usually sits around about 65 65% loan to value in kind of where they are in terms of the gearing across their portfolio. Now, if you're in that initial growth phase where you're at 75% loan to value across the portfolio, the issue that I've got there is that people go, oh yeah, I've got 25% equity. Well, that's right. You have 25% equity today. However, if you passed away, those properties would pass into probate. And in order to pay the tax bill, those properties have to be sold. And obviously, we all know what happens. You either have to sell those properties with the tenants in situ, which means you're not going to get full market value with them, which means it's only going to an investor. Another investor is looking for a deal, so they will only pay a certain amount for that. So you're going to lose 10 to 15% probably on a better one, based on the fact that these properties need to be sold. Plus then you've got the fees, the built up of interest if the mortgage hasn't been paid or whatever. So you've got estate agent fees and solicitors fees and inheritance tax. So that 25% equity is probably whittled down to somewhere between 5 and 10%. So you're not actually leaving that much, if anything, to your family. And that's in the good case. If in a bad case where the property's you have to vacate the property and then the property sits empty, the mortgage is building up, or the tenant's not paying because you're not actively managing, and there's various things that could go wrong. If your family weren't interested in managing those properties or knew anything about them when you were alive, imagine trying to pass those headaches over to them whilst they're trying to grieve, like you said, for your loss. Maybe they're throwing a little party, who knows? Yeah. They're not around anymore, But the reality is it's a painful, and we do jest, but this is a serious topic, and it is definitely one. And I think the life insurance like this goes hand in hand with will writing. I think we put it in a if anyone's aware of the sort of quadrant of tasks, anyone listening to this, where you've got urgent and important in quadrant 1 and important, non-urgent in quadrant 2, then this is a quadrant 2 task. And it's important, but it's non-urgent. And this is why people tend to then, along with their wills and things like that, is like they know they need to do it, but they just don't get around to doing it because the noisy stuff gets in the way and life gets in the way and everything else. So yes, super, super important.
Absolutely. And so just to add to that, it's not just the wills. The amount of times that I hear people, when being told about lasting powers of attorney, I'm young, fit and healthy, I'm not going to get Alzheimer's. It doesn't have to be Alzheimer's for a lasting power of attorney to kick into place. You could be a property investor that's doing up a property and a beam falls or you fall off a ladder, bang your head, and you've lost mental capacity. And if you're the only owner of that property, you're alive, but you haven't got mental capacity, anything financially related to that property, the purchase, the sale, the remortgage, is frozen because you can't sign for anything.
Yeah.
That becomes a pretty urgent problem if it's not in place.
It does. Of course it does. So do you have any, I guess you've got your own example of this, but I'm not sure if you've got any others where, what have you seen happen when somebody's got no protection in place?
Obviously, my family was a situation. They'd built up some credit card debt, which meant that things were difficult. My dad had an interest-only mortgage that it was going to run out. And at that point, he was close to retirement age. So whether he'd be able to remortgage in his own name on that was a question. And fortunately, I was in a position where I was able to step in and buy the property from him. So there's that, but not everybody's in that fortunate position. I haven't any serious ones. I've had ones where clients I've had an appointment with someone and they've gone, we need to think about it. And I've obviously pressed to see, is it a price problem? Is it a value? But they're just adamant that they don't want it at that point. And they've come back and gone, I've broken my arm. Can I get some insurance now? Because it's going to give me the fracture cover paid out that you told me about. And it's like, sorry, once it's done. Or income protection is a normal one because I used to advise in that manner where it was life insurance first, critical illness second, income protection third. And obviously, the majority of the first ever cases I did, I managed to land the life insurance most of the time, probably up in the high 90%. Critical illness, a little bit less, but still over 80% of my clients. But income protection was probably 1 in 5. 5 clients, and then they come back after they've been signed off work and go, is it possible for me to get this? Well, sometimes it is, but what often happened if it's like a bad back is that every income protection policy going forward is going to exclude payouts for bad backs. So if there's a re-injury occurs, which obviously is a highly likely once something's done once, it's not going to pay out for that purpose.
I remember there was something that you said at one of the meetings, it was a while back now, but really resonated with me, was around wanting to put the likes of Just Giving and these various other companies out of business. Do you want to just kind of elaborate on that?
Yeah, so nothing, well, actually, no, you've just reminded me. I was referred a potential client from one of the members at BNI, and I did a meeting with him, and he was like, I want to speak to my wife, which I despise that. I'd rather speak to both at the same time so that they can make a joint decision, because anything I tell a client is going to go off and then going to be repeated at only half capacity, if best. But anyway, I chased to give them the timeline, heard nothing. I then saw him post that he'd been diagnosed with a brain tumour, passed away with nothing. Just Giving page went up and the family needed to raise 10 grand just for the funeral. And for me, I'm like, I want to put Just Giving pages for families or for anyone essentially in the event of death. I want that to be a thing of the past. Only less than 83% of Just Giving pages reach their target. And I think it's such an irresponsible thing to do. If you've got kids, if you've got people that you love and you care about, to rely on them to have to run a Just Giving page to get by financially if you were to pass away is one of the most irresponsible things I think you can do. So I'm massively passionate about, actually, I want to be known for the reason that Just Giving pages in South Wales are no longer a thing.
Yeah, absolutely. Okay, so just moving on then to, obviously, we've talked about property investors, and property investors effectively, and now with the way the changes have come in, are business people, although it probably trying to be a bit more passive, but now they're entering into businesses. But also what we have is a lot of business owners who are business owners first, they make profits within business and then they reinvest that into property. What are the protection discussions for people who run a business? What are the key things that they should sort of think about that maybe they haven't considered?
I see it a lot of the time that you've got a business set up with more than one director or shareholder, and there's not even a shareholder agreement in place. So in that scenario, if one of them passes away, there's no set of instructions as to what both shareholders want in that situation. So you could end up in business with somebody's wife or somebody's child in that situation. If you want to be able to buy those shares off that spouse, and you have a shareholder agreement that says that's the priority, is that shareholder one will buy shares of shareholder two, is there enough liquid cash in the business to be able to do that? If not, then you can get a shareholder protection policy in place which covers each shareholder for their value of shares, and then in the event that one of them passes away, the business receives the value payout of the shares, and then that can be transferred straight away to the beneficiaries to buy the shares out so that you can carry on running the business without interference from parties that you don't want to be in business with.
Out of all of the businesses that you've spoken to about shareholder protection, how many of them have actually had the money in the bank to be able to buy the shares?
I've not found one.
Yeah, same. And so it's a loaded question because, if the reality is people when they write their will or when they talk about their wealth and various things, they will put they own a business and it's worth something, whereas it's only worth something if someone is able to buy it. And the value of and if your business partner has no way to buy it, then the only thing your family can do is go and sell your shares to the market to somebody who may have the money to buy it, and that could be a competitor, it could be a private equity firm, it could be anything like that, and that's something that your business partner may not want to happen, and so you can make all of these decisions whilst you're alive and whilst you agree between you. Rather than letting your family make those decisions after you've gone because they've got no other choice.
On top of that, you can then actually look within your business and think, if somebody within the business was to go down with an illness or to pass away, would the business be able to continue operating at the same level that it is. You may have a key member of staff. So I've seen one business where they had one salesman. He was responsible for all the income in that business. You can insure that person with key man insurance to turn around and go, if he passes away or gets critically ill, again, the business will receive a lump sum to offset the losses of that individual being no longer there. So the business can continue functioning. Because obviously, if all the income gets lost, but you've still got staff wages to pay, still got your rent on the office space to pay, then there's no more income coming in, or you've got to wait 3 months to recruit somebody to the same level, and then you've got to train them up. You're able to ensure the key people within your business so that the business receives the payment if cancer, heart attack, stroke, critical illness, or worse, they pass away while employed.
Yeah, fair enough. And so, look, I think the key message is if you've got a business and you don't have any insurances in place, then it's probably time for you to have a business review and understand, first and foremost, the different products that are available for businesses, because some of them are actually very tax efficient as well, but they can protect the business against something happening to you, your business partners, or your key employees. And also on another level is that you can just add some death in service for your employees, which is a very cost-effective way to add a benefit to your employees, which just might make them a bit more sticky when it comes to possibly looking at other offers for jobs, etc. So there's so many things you can do. Private medical care of as well, which obviously if you just rely on the NHS to get people back to work as quickly as possible, then you know they might be struggling with a knee or a hip or whatever it may be that they need an operation on, and that's impacting the profitability and productivity of the business. All of these things are available to you, and you can just take the time to see if that makes sense for you and your business.
Absolutely, and it's such a value add, and from an employer's point of view, you can show that you care for your staff without it being extremely costly.
So just tipping on to then, obviously we talked about an example when, you saw a couple of examples where people that haven't had insurance in place. Do you want to, obviously without naming any names, would you have an example of someone who has had a payout and really genuinely changed the outcome for a family?
Yeah, so both of them are actually close friends, which is quite ironic, but also I think is one of the biggest perks of doing the job. So a client who came on board a year into the plan was diagnosed with bowel cancer. He had a full protection policy. So he had income, he had life, he had critical illness, and he had private health insurance. The cancer was cut out of him, absolutely fine, but he received a nice lump sum, which meant that he didn't have to work in that time. He still got his income paid because he had the income protection policy in that time. And he's actually using that money now to actually invest and enhance his lifestyle. So that's a lovely one when it comes off like that, because one, he said he only really had 3 to 5 months where he didn't feel particularly well while he was going through the surgery, but he was given the all clear after 6 months. He had 5 months of income paid, so he didn't have to worry about bills during that time, and he had the lump sum. And because he had the private health insurance, he had the option, rather than going through the NHS, to be treated in a private room without waiting. But actually, it was the same surgeon that was being offered by the private health insurance as it was by the NHS, and the surgeon told him just to go through the NHS because it'd be no different in any time. But what he didn't realise, and I was able to advise him on, again, one of the benefits of using an advisor is when you need to claim, come back to us because we'll assist with that, was that the private medical actually offered a benefit if he didn't use the policy when required. So they ended up paying him a couple of £1,000 for not going through them. So he won across all those policies. Thankfully, he didn't need to use his life insurance policy. Another one was a friend who's a builder, and he'd taken out income protection, life with fracture cover, and he took it out literally the same day that he played in a charity cricket match that I was playing in. And he had a few drinks while he was playing because it was a charity match, but he was on the way of running down the crease. He tripped over, fell while holding the bat, landed and broke his upper arm. And he had week 1 deferred income protection. So from month 1, he was having his income paid, and they paid for a 5-month period. And he had a lump sum payment of £4,500 for his arm as well. So that was one, because when that happened, I was like, I hope there's not like a 7-day lag on the fracture cover, but because it was tied in, they were happy to pay it out. So we got that across the line. I was also worried because it was a same day income protection claim as well. I was like, oh, this is going to look bad, but it was one that I was able to evidence it all. And the income protection provider was more than fine with it.
Nice. So, I know I've had a couple of clips. I think I've had 3. These are the ones that stand out, of course, especially when you've got kids. But I've had 3 separate children's critical illness claims. And, it's crazy. But the impact that money makes on a family in a time where they've got it's supposed to be a nice time with young kids and everything else. You're enjoying the moment of everything, to find out that they've got something wrong, then having sort of 50k as a lump sum to support with going back and forth to the hospital, taking time off work, the cost of travel and fuel and staying overnight at the hospital, taking time off work, possibly getting some private diagnoses or referrals or whatever it may be, making adaptations to the home, going on holiday, whatever it may be, just that extra, childcare for the other children whilst you're back and forth to the hospital. There's so many things that's beneficial for. But the fact that I've had 3 of them has been, an interesting experience. So it's huge.
The big thing for that is that adding child's critical illness onto a policy, you can actually do it on a life policy. So not that I would advise any adult to not have critical illness policy in place, but if for whatever reason budget is so tight that you can't afford critical illness for yourself, you can add children's critical illness to a life only policy, and it's like less than £3 a month, and that covers all of your children. I think it's absolutely bonkers for £3 a month that people would turn around and say, no, I don't want to add children's critical illness onto my plan.
Definitely. So I'm conscious of time a little bit. There's a couple of things I'd like to carry on with. One is the importance of trusts. Do you want to kind of just at a high level kind of explain a bit about trusts and how they work and why they're so important?
So it's standard for us. All our clients have their life and critical illness policies put into a trust. Essentially, all the trust is a standalone document that means that in the event that a payout is required for death, rather than the money being paid into the estate and then becomes part of a taxable estate, it has to go through probate before it can be given to the beneficiaries. We can put it in place so that it bypasses the need for probate. It's excluded from the valuation for inheritance tax purposes, and the money will become available a lot quicker because there's no need for it to go to probate. And the amount of times I review people's cases that have taken their policies out online or taken them out elsewhere, they don't even know whether the policy is in trust. And then when we go dig and we find out that 99% of those policies aren't in trust, it's fascinating. It's a free thing to do. The advisor should always be advising on it based on the client's circumstances. But it's almost like, I've got the life insurance, I want to whack the application through as quickly as possible. No need to do a trust. I just want to get paid. And actually you're creating either an inheritance tax problem, or you're creating a long drawn out wait for that family to get hold of the money that's going to be able to pay for the funeral and whatever else needs paying for in the immediate aftermath of that bad news.
Yeah. And look, it's so important having those interests. Like I said, the speed for me is the important piece. 1 is the speed, and 2 is the obviously staying outside of your estate for inheritance tax, which, as we've touched upon, is a growing space. So nice little segue into it. Inheritance tax planning is obviously the big thing in our industry at the moment. Talk me a little bit through around what the thought process is and the conversations that people should be having if they're not already.
In terms of using protection for inheritance tax purposes?
Yeah, so just a little bit around what people can do to, if they, a lot of people don't even realize they have a problem. If they do, some of the thought process that they would go through to kind of try and mitigate it.
So the first thing is, let's have a conversation about whether you've got a taxable estate or not. And that goes both ways. If you don't, great. Can we help you get to the point that you are by using the guides and investing through property? If you do, are you having conversations about how to plan and prepare for it? I often think when it comes to inheritance tax, sometimes the simplest solution offers the best results. So I love a whole of life policy for this purpose, because a whole of life policy basically means that the life insurance will pay out when both parties, if it's a joint couple, have passed away. And because the policy is in trust, there's no inheritance tax on the value of the payout. So actually, rather than seeing it as an insurance policy, you see it as a savings account. So every month you're putting money in, and we're actually able to calculate for you when you're going to be in profit or loss. So I had one, the last one I did, it was the husband had to live till he was 113 and the wife had to live till she was 117 before they'd have paid more into their policy than they'll receive back. So being able to go, look, you're going to get 400 grand when both of you have passed away, that will clear your inheritance tax liability. We're able to go, but you're only going to lose on this if one of you lives to 113 or more and the other one lives to 117 or more. But obviously, if you'd invested that money in an ISA to build up to that 400k, it's going to be included in the value of your estate for tax purposes.
Yeah, and I think a lot of people, have, as you go on, if you've got business assets, if you've got property assets, you've got your home, there's a lot of, people, who've been married and divorced and pensions and so many other things. It's not an easy thing to work out. So, the advice really is, speak to us and kind of understand things from our perspective, but you need to speak to your IFA if you've got one, or somebody who deals with tax from an investment perspective. And then you also probably want to have a conversation with a tax planner or an accountant to understand the tax implications. It's not always, there's an array of professionals that you probably need to speak to understand the best foot forward and what you can do to try, to mitigate that as much as possible. But the advice is take that, if you can't work it out whilst you're alive, how difficult it's going to be for your family to do that when you're not around.
We work with all of the people required for that. So if somebody sat there and not sure, you don't need to go on Google and Google IHT advice. Come and speak to us, and then we will hold your hand through that process and put you in front of the right people as well.
Awesome. Thanks, Sam. So I'm conscious that you've been kind of an advisor now doing this stuff for the last 6 years, and you've been growing your business, and now you've started investing in property yourself. Do you want to kind of just give us a bit of a background as to, what you've been doing, how you're doing it, what your goals are within property?
Yeah, so I've always looked at property as a funnel of my income. I think in this day and age, you need to have more than one income to give yourself the wealth that you need to enjoy the most of your time on the planet. So I mentioned the first one that I bought was from my dad. So that's just a simple buy-to-let in Norwich. The second property that I've brought on is a lease option purchase. So I've got 3 years to complete on a purchase there, which is a split. So upstairs is a flat, which is on Airbnb. Downstairs is an office space, which once I complete the purchase, we'll look to convert with planning, obviously, across to a second residence there. And then I'm just in the middle of purchasing the third one, which is a semi-commercial property that we're actually looking at utilising the Welsh empty home scheme in. I think it's my goal is to get to the point where I'm earning more from property than I am from advising, just because I think it takes the pressure up. Not that I'm under huge pressure, but it's a very comfortable position to be in. And it means I can be more selective about which clients I want to speak to. Although I don't have any clients I don't want to speak to. So I don't know why I say that, but that's the goal.
Well, I think the goal, it's what you're trying to do is you're trying to create choice for yourself, aren't you? We talked, what the whole protection thing is around choice and having choices available to you when things happen, and being in a place where you've got the freedom to choose whether to work or not. Is you can use that example of if an immediate family member of yours had an accident and needed sort of full-time care, you could choose to give up work and to care for them. That's a choice that most people don't have. And, I totally understand why you would work towards something like that. So that's awesome. So obviously what we'd like to try and finish on with people that we interview who are obviously in this space, and this can be either insurance or property investing related. Have you got 3 top tips that you can share with us?
Yeah. Number one, speak to the expert. So like the example that I gave with purchasing my dad's house, I wouldn't have been able to do that if I hadn't have taken the advice from Gareth and his team, which I obviously was in and around on a daily basis. So get around people who know what they're doing and actually seek out the experts.
That was actually quite a quirky case of yours that we had at the time, wasn't it?
Yeah, it wasn't a fun one. It took about 2 years to get across the line. So yeah, we got that one done. Second one, I think, is patience. I'm probably the worst for this, but I'm working on it. We know where we're going, know what we want to achieve, want it all done today or yesterday. I think just being patient with yourself, not beating yourself up if you miss deadlines that you set or goals, just knowing that the compass was, I said it the other day, the compass was invented before the clock because the direction is far more important than the timing. So just having a bit more patience and being kinder to yourself. That's not saying don't have any standards, but obviously if you do miss, know that you've made progress.
And it's, I mentioned to you earlier around patience. It's so important that I'm going through that phase at the moment where we're actively trying to buy something and we just can't quite get a deal across the line. A couple have fallen through for whatever reason, and it's just there. And just like you said, when I look and I you start beating yourself up about it, but it's actually going, well, am I taking enough action? And so I'm taking the action and the outcome's not happening. Well, there's not much more I can do. Those people pulling out the deals and various things, that's outside of our control. And so I'm not going to beat myself up about it because we're doing the things that we need to be doing to make something happen. So yeah, absolutely. Patience is huge in investing.
And I think the third one I'm going to go with is a little bit off center and quirky, but it's similar to what you've just said, but like the use of the universe and manifestation. Like I've come from a family that weren't wealthy, but everything that I've wanted and gone after and put down on paper has come to me so far, or is on the way to me. So I think actually getting clear with your goals, writing them down every day, having that unwavering faith that everything's going to happen at the right time. I think with your situation, you may look back in a couple of years' time and revisit the properties that have fallen through, and there'll be a reason why they've fallen through for you. And it might not be obvious to you now, but that applies not just to property, but it applies to relationships, it applies to health, it applies to everything. Is that everything you want out there will want you back. You just have to send the right messages out to the universe.
I think sport's a great example of this. And funny enough, I wasn't really watching it, but it was on, the Commonwealth Games was on yesterday, and it was I'm not sure whether he was, because I wasn't actually watching it, I could just listen, I was listening to it, and I'm not sure if he was a swimmer or a gymnast. I think he was a Scottish guy, and he'd won gold, and the guy interviewing him, the guy on the pundit had said, I interviewed him over a year ago, and he talked a lot about manifestation and visualization and all of this stuff, and he was very explicit about what was going to happen. And it's basically all panned out. And so he was just kind of sharing that. And then you had Adam Peaty then, who's obviously been a fantastic Olympian and broken loads of records and everything. And I think he came third in an event. And they said, what's going to change? And he said, well, I can only change what I can change. I'll just go down. I'm going to write it all down. What went well, what didn't go well, and what can I control? And it's when you look at all of those things, you can and you internalize it. That's when you can make things happen for the better, isn't it? So brilliant.
Tony Gordon, probably the best life insurance advisor that the UK has ever seen, told a story about a British runner that went off to her first Olympics, and in the Olympic Village, she was put in with a couple of Americans, and they got into their dorm. And the first thing the Americans did was put a nail in the wall above their bed. And she was like, "What's that for?" "That's for our gold medals." And they both won one gold. And she said, after that first Olympics, when I went back the second time, I took my nail. And she won. Yeah. She won gold. Nice. So I think sport is a great example, and I think it's that really clear intention and almost like tunnel vision to it, but the unwavering belief that it will happen as well.
Absolutely. Listen, Sam, thanks very much for your time. I'm very conscious of it as well, because I know you've got lots to get on with. So thanks for joining me. Really valuable, and hopefully, even if just one listener has taken something from today, then it was a very worthwhile conversation, but I'm sure there will be more. So thanks very much for coming on the show, and we'll catch up soon.
Thank you, Gareth.
I think one of the biggest takeaways from today is that protection really isn't about insurance. It's about protecting the life you've worked so hard to build. We spent years growing our income, buying property, building businesses, and creating financial security. But very few people stop to ask what would happen if that income suddenly disappeared. So hopefully today's conversation has given you something to think about. If you haven't reviewed your protection for a while, now might be a good time to do so. Thanks for joining us, and we'll see you on the next episode. Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.